Moving averages get a bad rap in trading. And I think it's because far too many traders, they don't put proper rules behind them. Like trading crossovers without some other supporting information is probably not the best approach to using moving averages. So in this video, I want to cover using moving averages, specifically 3 EMAs. And I want to go through how we can use other variables to increase our trading edge. And before I go on, take a second to subscribe to this channel. And since I think you're going to like this video anyhow, how about you give a thumbs up below in advance? Okay, as mentioned, the 3 moving average crossover strategy. And it's an approach that uses 3 exponential moving averages of various lengths. Now, all moving averages are lagging indicators, but when you use them correctly, they can help frame the market. You can see how moving average can give you information about market states by looking at the alligator trading strategy that I made a video about not long ago. And using moving averages, instead of just buying and selling at any location on the chart, they can actually have traders zoning in on a particular chart location. And from there, traders can use various simple price action patterns to decide on a trading opportunity. So why 3 averages for a strategy? Keep in mind, there is absolutely no magic in moving averages, but they can be used to form the basis of a simple trading strategy that works. And for some reason, Forex traders, especially Forex traders, enjoy these types of strategies. And you can develop many trading systems using averages. But I want you to remember that complex trading strategies are not always best. And here's my mantra: when in doubt, do less. So what are the benefits of using a triple moving average strategy? Well, it shows us the longer term trend direction. And if the short term trend is in our favor, we can see a shorter term trend to determine if we're going to be taking a with trend or even a counter trend trade. And you have to keep in mind that the lagging nature of moving averages are not going to enable us to pick tops and bottoms. That's not a bad thing, as times when the trend does change, it can make for some pretty sloppy trading conditions. And the main difference between using just 2 averages, such as the golden cross strategy, and 3 averages is having a longer term trend direction. So as I mentioned, the 3 EMAs will have different lengths, and they're going to be 9 period EMA, the 21 period EMA, and the 55 period EMA. And some traders will use the 50 EMA as well, but it doesn't really matter what you use. The 55 EMA will be considered a longer term trend direction indicator. When the 55 EMA is below both the 9 and the 21, we are going to consider the trend to be up in the long term. When the 55 is above both of the shorter term averages, we're going to consider the longer term trend to be down. The 21 EMA is considered a medium-term trend indicator. And we want to see the 21 below the 9 and above the 55 for an uptrend. The 21 period should be above the 9 and below the 55 for a downtrend. The 9 period EMA will be seen crossing over and under the 21 period more times than it crosses the 55. The 9 EMA crossing over the 21 while already above the 55, that's an uptrend, and we're going to be looking for a buy trade. If the 9 crosses below the 21 while already below the 55, that is a downtrend, and we're looking for a sell trade. And there are going to be a lot of times where that 9 EMA is going to cross over the 21 period, which will turn the short-term trend against the longer-term trend. And there can be trading opportunities in line with the shorter-term trend and against the longer term trend direction. That's counter trend trading. And when we get a mix of trend directions, we can be a little bit more conservative with profit targets, and we have to exit when we face adverse price action. So here's the strategy for trading with 3 averages. And we could simply trade the crossovers, okay, but that's not the best way of using them. You can expect a whole lot of whipsaw if you decide just to trade based on a crossover. You can tell a lot about the market from the state of the averages. When the indicators are all jumbled together, consider the market is in a trading range. When the faster moving average, which is the 9, starts to pull away from the others, we can consider that momentum is entering the market. Seeing the 9 and the 21 EMA crossing and separating, well, now we're looking at a trending market. And when all the averages line up, consider a strong trend to be in play. So just from those four things, we can determine what type of trading setups we need to enter the market. So let's look at a buy setup. And this is a 1 hour price chart of a Forex pair. And it doesn't matter what instrument we're using. So we can look for the moving average to line up in the same direction in order, the 9, 21, and the 55. Once that final cross takes place, in this case, the 21 crossing the 55, we look left for a swing high. If that swing high has been taken out, we can enter the trade on the close of the candlestick. And you can see it in the green arrow. If the swing high has not been taken out, we have to buy on the close of the candlestick. That does take out the swing high. And you can see on the left side of this price chart that the swing high was taken out prior to the cross. So you buy the close. Now here's a continuation trade. Just one example. Once we are in a confirmed trend, and that is when all the averages are lined up, we can look for the 9 EMA to cross over the 21 EMA, which will reverse the short-term trend direction. Using the exact same rules, we need a swing high to be taken out once the 921 crosses back into an uptrend. And I want you to note on this chart with the red X, and while the averages did cross, the swing high was intact, and that saved us from taking a losing long trade. If we do have a crossover in the short-term trend, we don't know if we're looking at a potential longer-term trend change. So the key to that is you have to read price action. So if the crossover happens, price is essentially performing a pullback. And in pullback trading, what we don't want to see is strong momentum in the direction of the pullback. If momentum occurs when the averages cross, I would suggest that you stand aside until price normalizes. For the short setup, we use the lowest swing low of the range as the area that needs to break to consider shorts. The 21 EMA has crossed the 9 and crossed the 55 EMA, sets up our short. So the close of the candlestick that forced the moving average crossover. Now the short setup is just the mirror opposite of the buy setup, and they share the exact same vital variable where we need to see a pivot high or low broken before taking the trade. Now what about stop losses and profit taking plus trailing stops? And there are a whole lot of ways to place your stop loss on these types of trades. There are a few things that you should keep in mind though. You want to allow room for price to move, so you want to avoid a tight stop loss. And be consistent. Using 2 times the ATR, that allows your stop to remain outside the normal volatility of the market, and it'll allow price to fluctuate. Using previous highs or lows, they're a simple visual area, but due to that lagging nature of moving averages, those pivots may be far from your entry price. Here we have the cross to the downside on crude oil futures, and the candlestick we would have shorted is marked. You set the stop to 2 times the ATR or choose the swing high. So in this case, we get stopped out. But if we didn't, as an example, we could just trail the 55 EMA or trail the 21 EMA or set profit targets based on risk multiples. You could also aim for previous swing low zones for a take profit area. Here's another continuation trade. So consider this a second example. As we talked about earlier, we could use the shorter term average crossovers for continuation trades. But remember what a crossover represents. It's a change in the direction of the trend, short or longer term. So that means you could be looking at a market that's getting weak. And using our rule of needing a swing high or low to be taken out before taking the trade, that can save us some losing trades. But what about a strong trending market? So I want to go back to the crude oil chart, and I circled a gap in the averages and how far prices moved from the averages. Price dropped with momentum. And although the cross of the averages is a trade, you may have had trading plan rules in place forcing you to stand aside. Why? Because you would expect a snap back in price due to the previous momentum. And this is where continuation trades are going to come into play. Price pulled back into the 21 and the 9 EMA zone. A reversal pattern, a reversal candlestick, or simple trend line breaks is a trade trigger. Stops can go above the last high candlestick. And rules regarding profit taking are the same as the other strategies I just mentioned. What about Bitcoin? Here we have price pulling back, and a large momentum candle takes out the previous 4 hours to the upside. With pullback, momentum steps into the market. With pullback into the EMAs and inside candles, those are actually lower time frame ranges, and you can trade the breakouts of those, or we have a trend line break entry. So the key points are the market's trending. The market has upside or downside momentum, and price just pulls back in between the 921 averages instead of across. And as with all trading strategies, you have to back test your rules, and you have to design a trading plan that includes everything from the markets you're going to trade all the way to risk tolerance. So what are my overall thoughts on the EMA trading strategy using 3 of them? Well, the lagging issue with averages can cause problems, such as price moving too far, too fast. So that can have us getting into a trade just when price snaps back to an average price. But the good thing is that we can judge momentum based on the separation of the averages as well as the distance price is from the averages. Adding in the needed breaks of swing levels in all trades except for the continuation to method, the second example, that ensures that price action is showing us a trending price pattern. Having 3 averages, it helps us have zero doubt if a market's trending or is ranging. If we see separation in the averages, we got a trend. If price is whipping back and forth around the averages, we have a range. Simple. And if you don't blindly trade the crosses, you could find an edge in this type of trading strategy where you take advantage of trend, momentum, and a simple trade management and profit taking routine. Thanks for watching. Hope you subscribed.